What's up everyone, it's Scotty with MoneyVest. So in this video we are going to be talking about Google, ticker symbol GOOG, and Google obviously dropping quite aggressively after the earnings came out. It was down a little bit over 9, almost 10% on that day, and a couple days later, of course, it's just kind of consolidating sideways. The selling pressure seems to be exhausted right now, but it's possible that it drops obviously a little bit lower. Anything is possible in the market. But in this video I wanted to break down all the fundamentals, go over all the revenues, earnings, margins, and we're going to run through our analysis of the intrinsic value calculator, and I'm going to go over both the discounted earnings multiple model, which is what we use. We basically discount all the future earnings and the price target back to present value to figure out what the intrinsic value is, but I'm also going to combine that with a very quick discounted cash flow, and this is also called a reverse cash flow model, which I'll show you what that basically means. We've been using it, and I did the video on PayPal yesterday, and I've kind of reformatted a lot of the spreadsheets to kind of make it more appealing. And don't worry, a lot of that is going to be available on the MoneyVest Pro platform. But as always, if you enjoyed this video and find it helpful, make sure that you drop a like, and don't forget to subscribe to the channel. That's all I'm asking in return. And the link to our Discord and Patreon is going to be down below. Don't forget, there is a 16% annual discount that's available for another 2 more days. So after October 31st, it is going to expire. And I also want to mention that we do have the Halloween sale right now for all the educational courses. So they are going to be 50 to 60% off, coupon code Halloween, and this does expire on November 1st as well. Link's going to be down below. There's over 50 plus lectures per course, and there's lifetime access with tons of content, and you can download a lot of the spreadsheets and of course PDFs and cheat sheets, and everything's going to be included. So link's going to be down below. So this right here is Google's numbers. So what you'll notice is that since 2009, actually, Google has done an incredible job in growing the revenues, right? It's one of the very few companies that has been able to grow revenues at just a little bit over 20%. That's the CAGR, compounded annual growth rate, as you can see over here. Now, gross profit has also grown by a little bit over 19%. So that's, again, very, very phenomenal. Margins have declined since 2009, 2010, when Google was doing a little bit over 64, 65, 60% margins. They have now settled at around 57, 55% at the moment. In 2023, these are all expectations. So, of course, revenue is expected to be just over $305 billion with gross profits of about $168 billion. Operating income just a little bit under $80 billion expected, 26% margin. That's also grown at over 17% for the business. Net income at just over $67 billion. We're going to be using this number. It's really important to keep this one in mind because we're going to be using it and plugging it into our analysis to better understand what the future looks like for Google, right? Because this is only past performance, right? This is all the last 13, 14 years. But what we want to know is what the future looks like for this company, right? Net margins have also come down from 26, 27, 29% to now settle at around 21, 22. They have, been a little bit higher at 30%. So for example, 2021 was a phenomenal year for Google. I think it was up 60% year to date on that year. Then 2022 brutal because of that significant decline year over year from 76 billion down to just under 60 billion because the ad spending was low. But this year it's expected to accelerate once back up. $67 billion is going to be that number. Shares outstanding have consistently gone down. Now you'll notice that the share count hasn't really moved since 2009 when there were about 12.7 billion. This again is on a split adjusted basis, and now they're sitting at 12.76 billion shares. But this right here is the number calculated since 2015. So the last 8 years, the shares have gone down by 1.9%. So in other words, Google has accelerated in their efforts to share buybacks in the last 8 years as opposed to the last 14, 15 years. EPS also expected to go up to 527. At least that's what my expectation is going to be, and analysts are expecting at 574, so they're a little bit more optimistic with a 30% growth rate on a year-over-year basis for Google on the entire fiscal year. Cash flow is a little bit over $67 billion. That's going to be a 22% margin, so that's going to be that number there. And we are looking at a significant amount of net debt. So again, it's one of the most well-equipped companies in terms of cash in the world, next to Apple and Microsoft and of course Amazon and all those companies that have a ton of cash with little to no debt. So only about $14 billion of long-term debt, $120 billion in cash and marketable securities, which makes Google one of the, again, like I said, one of the best companies from a financial health standpoint of negative $106 billion of cash that they can deploy as they see fit. They can give out dividends, do share buybacks, invest in other projects, invest in their own business to grow other parts of their businesses as well. So we know that Google, again, And it was a fantastically run business. There's definitely a monopoly when it comes to search, and they are also in Google Cloud, other Google services and advertising where they compete directly with Meta and a lot of other advertising companies. So there is a significant moat. And if you take a look at net income, it's grown by 18% over the last, 14 years. If you take a look at EPS, it has also grown by over 18%. Now, like I said, the last 14, 15 years worth of growth is very strong, but moving forward, the competition's only getting more and more fierce when it comes to the cloud business, advertising, not to mention search, with Microsoft now also, putting a target on Google's back when it comes to Bing search and all the other search engines powered by artificial intelligence. So what we're going to do is we're going to obviously assume a lower growth rate over the next 5 years. This is going to be the analyst expectations. They expect, 2023, 574, 2028, 1276 for EPS, and that's going to be a growth rate of just over 17% for the business. So 17% is what the analysts are expecting. 18% is what the company has done in the last 14, 15 years. I'm going to go ahead and put down 16%. Just to be on the safe side, it's going to be a little bit lower. We may have to lower it also further to kind of be more conservative, but all of that is going to be covered in our valuation. So first, we're going to run through our discounted earnings multiple model. This is the exact same thing as we have already gone over here. So for the longest time, you guys are more familiar with this sort of model. I've just kind of repositioned it to make it look a little bit more appealing. So this is what it's going to look like moving forward. And if I plug in Google over here, what we're going to do is we're going to put in the 2023 expected net income, right? So remember when I mentioned, this is the number to really be looking forward to, 67230. I'm going to put that number in. So 67230. So that's the net income expectations for this year. Now, what we have to figure out is, of course, the growth rate, right, from year 1 through 5. And that's exactly what we have done in most of our analysis in the past. So what is going to be that growth rate? So like I said, I'm going to go with 16%. Analysts are expecting a little bit over 17. The company's done 18 in the last 10 years. I want to be a little bit lower, so 16% I think is reasonable. Now, when it comes to expected P multiple, right, the price earnings multiple, I think Google is traded on average at around 20 to 24 times price earnings multiple in the past, and right now I think it is trading at a little bit over 23, 24. So if you come over to the statistics, market cap's at $1.53 trillion, and we're looking at a price earnings multiple of 23, right? 23.67. So it wasn't that far off. I'm, expected 24 to be that number. So we can go ahead and put down 20 just to be a little bit more on the conservative side again. Discount rate, as you guys already know, we use 12%, at least right now until the yields get up to over 7-8%. Then we'll have to push this number out to 14-16%. 10% margin of safety, and the share dilution, if you come back to the analysis, as I said, they have bought back shares of 1.9%, every single year in the last 8 years. So I'm going to go ahead and put down minus 2%. So this right here, minus 2%. Is going to be that number. And take a look, right? The actual estimated intrinsic value ends up at around $127, $128. This right here is going to be that sensitivity grid that we are all familiar to seeing. Now, I do think that the growth rate may still need to come down a little bit. I think 16% is still a little too high for the company if we're talking more conservative estimates, because based on this analysis, Google would be considered as somewhat undervalued, right, by 4%, because right now it's trading at 123. The fair value ends up at 127.95. So that's 4% undervaluation. But if I go with slightly lower growth rate of 14% and about let's just do 18 times P multiple, then we're looking at about $105. I think that's a lot more reasonable because, look, like I said before, we don't want to, pin down our analysis on the most optimistic and even more of a base case scenario. And then if things don't turn out the way they're supposed to, well, guess what? There's a lot of margin of safety that needs to be built in. So I think a 14% growth rate with an 18 times multiple, I think, is a lot more reasonable. And that way we end up at around $105. And originally my fair value was at 96, right? So it's been updated a little bit from 96 to 105. That I think is a lot more reasonable, which only means 14% more potential downside needed for Google to be trading at its intrinsic value, right? Based on the discounted earnings multiple model. Now, this right here is going to be the forward price earnings. You can see EPS is going to grow from $6 to $11. It's kind of in line with what Wall Street also has. And $105.56 is going to be the potential estimated intrinsic value based on this model. Now, I also want to run through the discounted cash flows, okay? So this is a little bit different. So we're not projecting net income, but we're projecting free cash flows. So what we're going to do is we're going to come over to Google here. And we're going to come back to the stock analysis spreadsheet, and we're going to go over to Google's free cash flow for this year, 67,230, which I believe is very similar to the net income, but that is going to be, again, a 22-21% margin. Now, this is going to be a little bit different. So once we plug in 67,230 as the free cash flow, not the net income, but the free cash flow for the business, now we need to project the free cash flow growth rate and also a terminal growth rate, meaning what is going to be the growth rate for Google's free cash flow after year 5 till the lifetime of the business, right? So once we do that, and this number needs to be somewhere between 2 to 3% because we're kind of projecting out, for the life of the business, and obviously no company is going to be growing at 12, 15, 18% forever. So we expect the terminal growth rate to be significantly lower than the actual year 1 through 5 growth rate. So if you come back here, free cash flows have grown by 16%, as you can see over here. So 15.913, that's going to be this number over here. So I think I can go a little bit more conservative, a 14% growth rate from years 1 through 5. The discount rate is going to stay the same at 12%. We're not putting in any sort of a P multiple for this example, but we're simply forecasting for the growth in free cash flows from years 1 through 5 and the terminal growth rate, which is going to be year 5 through the life of the business. So Google, I'm going to go ahead and put down 3% as a reasonable number. Minus 2% is going to be that share dilution, as we've already mentioned before, and about a 10% margin of safety. Look, if I don't put down a margin of safety, so if you just go with that minus 2% share dilution and I don't put down a margin of safety, we arrive almost at an identical fair value, intrinsic value, about $106 as we did with our discounted earnings multiple model, right? Which is about $105.56. So those two almost end up being similar, but we have to account for the 10% margin of safety. And that's when we are more in line with my previously calculated intrinsic value of $96, right? So now it's sitting at $95.43. So I would say like somewhere between 95 and 105, like that $10 range would be somewhat reasonable for Google. And if they are able to grow at a 14% free cash flow and about a 14 or 16% did we choose for the earnings, actually 14% for net income as well. So if Google can grow both profits and free cash flow by about 14% over the next 5 years, which I think is reasonable considering analysts are pegged at a higher level, and in the last 14, 15 years, they've actually grown at 18%, then the fair value or the intrinsic value ends up at around $95 to $105 per share, right? So that's going to, obviously be a little bit lower than where it's trading at the moment. It's going to be somewhere around this level. So this right here would be pretty much, the fair value area for Google, which is going to be lower than it's going to be 23% lower than, actually 16-17% lower than where we are at the moment, about 14-15% lower. So that's where we are. And of course technicals, they are coming down to oversold levels, so we are selling off a little bit, and next support's really going to be down to $116 all the way down to $109 per share. So those are both technical support levels to watch, with the resistance sitting right over here for the company, sitting roughly at 127 to 131 for Google. And of course next support really is going to be all the way down to, like I said, at 115 to 109, with my fair value sitting between $95 and $105 depending on the earnings growth and of course free cash flow growth for the business. So I hope you guys enjoyed this video and found it helpful. Let me know your thoughts down in the comment section below. Don't forget, we do have a coupon code Halloween available until the end of this month, 50 to 60% off on courses. And as always, happy investing, and I will see you all in the next video.